Okay, class, let us get going. Otherwise, the other students will get us along the way. Time now is 2:14:17. Then we've got to start anyway. We're delayed a little bit because of the feedback from the received from Dr. Mkadi for the first assessment. Right, then we have to look at the learning objectives for revenue and receipt cycle so that we understand what we need to know about revenue and receipt cycle. We have to be able to explain the nature and purpose of this cycle. You also need to identify and describe the major general ledger accounts affected by the cycle. Further, explain the accounting treatment required for the recording of revenue. Identify and explain the cycle's functional areas. So you have also to describe the flow of transactions in the cycle through the information system, including its relation to source documents and accounting records, and its relation to classes of transactions and events, as well as balances. 6, we've got to identify and describe the documents and records, both manual and computerized, used in the cycle, and describe the purpose of each. Number 7, we've got to identify and describe the risk of misstatements affecting account balances, class of transactions, and events in the financial statements. So the risks are also known as what could go wrong. That question addresses the issue of risk, because risk means something going wrong and failing, which can lead you to fail to achieve your set objectives. Right. Number 8, you should be able to describe the computer technology typically used in this cycle. Then, number 9, formulate control objectives for this cycle. Number 10, we have to describe internal controls, how internal controls may assist in achieving the control objectives in the cycle, and how these control objectives relate to management assertion in the financial statements. Critically analyze internal control system in order to identify and explain weaknesses in the control systems and recommend improvement by describing the required internal controls. Then lastly, we've got to be able to design a system of internal controls, both manually and computerized, that will achieve the cycle's control objectives. So you've had some new concepts like your control objectives. Internal control is no longer new. You know how to define that. So we'll be able to define control objectives pertaining to this particular cycle, which is receipts and revenue and receipt cycle. Also, the computerized environment, you'll find that there is a slight difference from the computerized environment and the manual environment. As we're going to computerized environment, you'll find that issues of access controls into the computer, physical computer, and access controls into the programs becomes an issue, and they form part of your internal controls around those particular cycle, and just getting to the computer and straight into the cycle itself or the system itself. So there is a question that you cannot see what I'm sharing. What I'm sharing, I didn't share that. I'm just telling you the learning objectives that out of this particular lecture, you should understand how to deal with the 12 issues I've been referring to. So you cannot see that because my presentation slides do not have that, right? Okay, let's move a little bit now to our first outcome, learning outcome, which is explain the nature and purpose of the cycle. So I wanted this particular lecture to be kind of interactive. You can interrupt anytime and ask questions. I want you to ask questions so that I can see that you are all awake. even comment if you feel like commenting to show that you know what we are actually dealing with today. Right. Then what are the nature, purpose, and accounting implications of this particular cycle? So as you know that revenue and receipt cycle deals with selling goods, rendering of services, receiving cash in exchange of goods sold, sales return, and also writing off bad debts and recording transactions into the accounting books. Businesses exist because they are selling something or they are rendering a particular service that is needed in the market. So it follows that this cycle becomes a very imperative cycle when you're dealing with cycles that will follow, because it touches into the very existence of the business, and you can also evaluate your going concern assumption based on this particular cycle. Are sales increasing or are sales decreasing? Then if they are decreasing, then there is a problem. How about debtors? Our working capital in accordance with the necessary industrial benchmarks in as far as liquidity ratios are concerned, and also your acid test ratios and so on and so forth. So the importance of this particular cycle cannot be overemphasized. So lastly, with regards to the nature and purpose, is that sales are included in the financial statements as revenue, and sales can also happen through cash or credit. So companies, if they want to encourage their products to be sold, what they do is that they extend credit to their customers and improve their sales. But now, getting into credit or selling goods on credit also have their own risk, in the sense that you can end up having what we call bad debts. As you could see in bullet number 3, there is writing off of bad debts. People who are recalcitrant, who do not pay their accounts, who have defaulted in their accounts, and there is no hope that they will be able to pay. So in this particular cycle, we deal with those, and those are general ledger and as well as your debtors ledger transaction. Sales returns. In some cases, you'll find that whatever we sold as goods are actually bad. In fact, they are bad. There are some defects, or they've destroyed en route to the client. So in those particular cases, your customers will return those, and necessary adjustments are made on sales as well as on your individual debtors accounts. So the last one is recording your transaction in the accounting records. Your accounting record starts from books of prime entry. They start from your documents. In this particular case, you'll see that the trigger will be an invoice. Then you put it into your books of prime entry, your sales journal. From your sales journal, it goes to either your cash receipts journal, or it goes to your debtors journal if it's on credit. So those are the activities happening under this important cycling. So let us move to bullet point number 3. I've alluded to sales being included as revenue in the financial statements, and in particular in the statement of comprehensive income, or in the statement of profit or loss. Right. Right, let's look at the forms of revenue that you might encounter. You'll find that in case of retail, you'll find some revenues there. Wholesale, there's revenue. Manufacturing, their own revenue, which are sales. Resource or generating mining, there will be mining sales happening there. Services as part of your sales. Municipality, for instance, for rendering services, they will have their sales there as rendering of services. Electricity rates and so on and so forth, they will be classified under revenue. So your retailer will be any entity that is selling direct to the public will be a retailer. Retailers that are actually known by all South Africans will make mention of Spar Group. You'll have your Checkers, you'll have your clothing like your Edgars and so on and so forth. Then those are your retailers. Then they have their own revenues. Boxer also serves as a wholesaler. Your Macros will serve as a wholesaler. They are selling goods to resellers in bulk, not necessarily to the individuals. But Macro has got a different business model altogether, selling direct to public as well as to the retailers. So your manufacturing entity will be selling their products to the wholesalers or retailers directly. So they earn revenue for actually doing that. And your mining company will be selling your minerals to whoever is interested in minerals, your minters or your jewelers, right? An accounting firm rendering a service will always sell their services and intellectual property to their clients through auditing, through taxation services, your bookkeeping services, and everything pertaining to accounting. Then we've alluded to the fact that municipality will be providing utilities to town residents. Those utilities will be your collection of rubbish, will be your water, electricity, as well as your rates. So you can also mention the university. The university will be charging their students fees, university fees, then they'll be part of revenue, and the students will be, because they are not paying, those who are not paying the full fees, they'll stay in the books of the university as student debtors up until they finalize. In most cases, it's topical at the beginning of the year because most students are unable to pay, and there's always some negotiations and counter negotiations during those periods when students want to register for a new semester or a new academic year. So those student debtors will negotiate and they'll get registered. And those negotiations form part of internal control by university to ensure that they collect their revenue, and debtors that are there are not written off as bad when they are still alive and studying at a particular university. Right, those are the forms of revenue that one may get from different companies. Right, any questions so far? So now the question comes, to whom does each of the above entities sell? We have explained that. Then we look at number 6.1.3, the varied nature of the cycle. So this particular revenue cycle will differ from entity to entity, but the control objectives for this particular entity or for this particular cycle will remain the same whether you are a different company or not. Your control objectives will remain your accuracy, will remain your completeness, and validity to all your entities. But in terms of the activities that are performed there in the cycle will actually vary in accordance with the entity, from one entity to another. But the control objectives, as alluded to, will remain the same. So the aim of control objectives being looking at the validity of transactions, accuracy of transactions, and completeness of transactions. Transactions, as disclosed by management in the financial statements regarding this particular cycle, is also referred to as assertions by management. So we'll find that management will say our revenue is so much, and that is an assertion by management. So the control objectives internally will be is that revenue valid, accurately recorded, and complete in all material respect. So those are control objectives, and auditors also will come up with their own exception to actually audit those exceptions or assertions to find out and get more evidence to the fact that everything was in line with what management is asserted to in the financial statements, so that no material irregularities, not irregularities, but material misstatements actually occurred in this particular cycle that can actually render financial statements to be unfairly presented, as it were. Right? So we've mentioned that the internal control will remain the same for all the entities, irrespective of what they are doing. And right, still in the nature, purpose, and accounting implications of the cycle, let us look at the two questions. What triggers a revenue transaction in the cycle, and what triggers a receipt transaction in this particular cycle? Right, who can give us an answer? Anyone? So the first one, what triggers the revenue is the invoice. Once you get an invoice, you record everything into the books of prime entry, which is your sales journal. Then you move over to your general ledger. You're looking at your bank account when it's actually on the goods were bought on for cash. Then you look at your cash receipts journal, which is also a book of prime entry. Then your bank account, which is actually residing at your general ledger. And if goods were actually bought on credit, then we'll have to look at your debtors, individual debtors. Then the balance will be sitting at your general ledger. So when that has been done, it has been triggered up until transactions are recorded in the general ledger, and from the general ledger then to your trial balance. Then that particular revenue cycle will actually end at that point. And what triggers a receipt transaction? The payment. Once the debtor or whoever pays, then it triggers that particular transaction. You'll see that putting into the books, it will go to your cash receipts journal and into your general ledger through the bank account. Then after we have done that, it has been triggered, and it ends when you actually post both your revenue and your account and your receipts account or transaction into your general ledger, as it were. So here it says these triggers end when transactions recorded in accounting records and posted to general ledger. Then the triggers will start again when there is an invoice from the client to the client, because it means there has been an agreement that sales have been made. Then recording again, and again. Each time there is a sale, there is a trigger, and each time there is a payment, there is a trigger. Each time there is a sale, there is a trigger. Goes on and on and on up until the end of the financial year. I can't see what you are sharing now. Guys, can you see what I'm sharing? Okay, good. So there is a question here that the transaction is actually triggered by this particular transaction is triggered by an order from the client. Okay, can you explain that to us? There is a student who said the trigger is, which I think they are correct, but now they must actually tell us how. Student, I don't see your name now. Please assist us. We want to move a little bit. Okay, if you're looking at your books on page 186, if you're using the old book, then we'll see that these are the triggers for the cycle. For a revenue transaction to commence, an order should be received from a customer. For a receipt transaction to commence, payments should be received from a customer. Thank you very much. Yes, that is very true. And I wanted you to explain that, which was going to make a lot of sense and make me happy that you guys are participating and you are not computers. You can actually speak. Right. Thank you very much for that. Then let us move a little bit to the next slide, which is dealing with typical transaction in the cycle. We have to look specifically at a wholesale entity. A wholesale entity, a customer orders goods, then pick up goods from the warehouse, deliver of goods to the customer. Then when the goods are delivered to the customer, invoice customer for sale of goods, that is record sales, and receive payment, then record payment, and that's the end of the trigger. Then it starts again each time they buy. So when customer orders goods, you receive either an email or you receive it would be an email or whatever the suppliers. Maybe they will have an order number, an order document to say we are ordering so many goods, and from there you will do what you call an internal order, which is sequentially numbered for goods to be picked up at the warehouse. Then the warehouse or the dispatch will do something called a delivery note, because goods now are delivered to the client. The client will look at the quantity of goods and the prices and sign to say, yes, we've received those goods as evidence that they've received those goods. After that, the delivery note, together with the order, the client order, is taken to accounting department for invoicing, and they record the accounting department will also record a sale and debit data up until they are paid. Then when they pay, then payment will be received, and that will be the end of the cycle. And then we'll start again. In a resale situation, same thing applies. Customer selects a goods, receive a payment issue receipt that we record in sale immediately, then customer leaves with the goods. And it's so simple, straightforward to get into any spa outlet, for instance. You take whatever you need, you pay, then you go. Then the point of sale systems now are able to record and take out stock immediately, and you are done and you leave. And the transaction has been recorded, money has been received, and when you leave, everything has been sorted out. The triggers have come and gone. Right, questions? So if there are no questions, let us look at the major accounts in this cycle. So we first look at the statement of comprehensive income, also known as statement of profit or loss. So what we have there, we have your revenue, which is how you earn your money or what you actually do. Revenue in most cases define what an entity does. For a retail like SPAR, you'll find that your revenue will comprise sale of goods, not services. Sale of goods, whatever they are offering inside in shop will be stock. Once it's sold, becomes your revenue, right? Then we'll have your sales return, as alluded to before. Sometimes you buy something from SPAR or any supermarket outlet, and you go out home trying to use that particular product, you'll find that the product is actually reached itself by date. You return it to the shop, they exchange it for you, and those are called sales return. They are returning bad products. Then, under our statement of comprehensive income, we also have bad debts written off. Your recalcitrant debtors, your debtors that are actually defaulting, people who have actually been sequestrated, or people who do not have an assumption of going concern on their side, they cannot pay you, and by law, you should write them off, because once you keep them in the books, it means your debtors have been overstated by the amount that are irrecoverable. Because in the financial statements, the assertion should be that whatever you put in as your debits or credits, or your assets or liabilities, if you may put it simple, it means that you are able to recover and you are able to pay off those liabilities as an entity. If you are losing the assumption of going concern pertaining to your liabilities, but your debtors, they should be recoverable. If they're not recoverable, then write them off immediately. So the auditors are also interested in looking at the value of debtors and how debtors impairment is actually being assumed by management, because it's part of the assumptions by management. Right? Let us look at other major accounts. Your statement of financial position, you've got accounts receivable, including trade debtors. So you also have cash and cash equivalents. Cash and cash equivalents will be either cash or any instrument that can be converted into cash within a reasonable period of time, usually within a year or 6 months. So those are cash and cash equivalents. So bank account monies with the bank are also part of cash and cash equivalents. So those are major accounts that we find in your revenue and receipt cycle. Right, let us move to revenue recognition. I think you need to ignore IS 18. Now we've got IFRS 15, right? So in terms of IFRS 16, there is a particular way of recognizing revenue. You recognize revenue at a point or over a period. And there are 5 steps that you should actually follow to ensure that your revenue is actually recognized in a manner that is in compliance with the standards. So I see here students are leaving one by one, and when the assessments come, then they have a problem. I think you should actually refrain from leaving classes, because attendance is also contributing to your pass rate or failure rate. So please always be within. Otherwise, it makes no sense that we continue when students are going out. Because at the end of the day, when the marks are allocated or when students are not successful, they always blame it on the difficulty of the course. But you must attend as per your course outline. You must go to your tutorials as requested, then we'll pass this particular course. Please don't leave class. Right. Let us quickly go through. I wanted to share a screen pertaining to this particular standard, IFRS 15. But anyway, to cut matters short before we go there, let me just simply say revenue should be recognized in accordance with the provisions of IFRS 15. IFRS 15 actually describes what is a contract from a customer and how revenue is supposed to be recognized at a point or over a period. And there are 3 steps that you follow so that you record your revenue appropriately. Failure to do so can actually cause financial statements to be unfairly presented, and the auditor will actually issue or provide a modified opinion pertaining to this particular cycle, because you didn't follow as an entity, you didn't follow the provision of IFRS 15, and it's not IS 18, it's IFRS 15. You must scratch that and refer to the book, right? So we've spoken about consequences of incorrect or inappropriate measurement. Right, this particular cycle has functional areas that we need to look at. So the functional areas that we'll find in this particular cycle will be credit management, the purpose of which will be ensuring that credit applications are assessed and credit is only extended to credit-worthy customers. Receiving of orders from customers, that is a functional where orders are received, and receiving orders from customers, checking inventory levels, and so on and so forth is done in this particular functional area. Authorization of sales orders. So before an order can be dispatched, it needs to be authorized by relevant officials, and to ensure that the issue of credit lines offered to clients and credit limits are adhered to, and the client is still credit worthy in case of those clients who are buying on credit. Picking off goods from warehouse, another area. Who's going to be picking up those particular goods from the warehouse? So the main activity there, as the name suggests, will be picking off goods from the warehouse. So people will be seen. There will be a storeman, your warehouse supervisor, or manager, and so on and so forth. Then the 5th will be of dispatch and delivery, goods, delivery of goods to customers. That will be suggested even in the name, that you have to dispatch and deliver goods to the customers from the warehouse, then deliver to the customers. Your dispatch clerk and your gate security guard and driver will be responsible for this particular activity. Then we've got your invoicing. So the purpose of this particular functional area is to create and issue an invoice to customers, notifying them of their obligation to pay the goods and services. So the main activity here will be creation of customer invoice and actually transmitting as such to your customers. So people who are responsible are from the Department of Finance, should be your accounting clerk, your invoicing clerk, whoever is actually depending on the title given by an entity to entity. So we cannot say it's an invoicing clerk, could be accounting clerk or whoever is actually been mandated to do so. Then you've got your recording of sales in the accounting records, done at finance as well, or it's done at point of sale in some cases. So receipts of cash from customers, also a finance activity, receiving of cash from customers, recording, issuing receipts, depositing cash in the entity's bank account, and so on and so forth. So long time ago, checks will always come through your mail. You have to have people who are opening your mail. We've got 12 clerks responsible for like cashier, chief cashier, security guard, looking at the activity to ensure that there is no embezzlement of resources in this particular functional area. Then the next functional area will be recording of receipts in the accounting records. That will be done by your cash book clerk or whatever. And lastly, your processing and recording of returns and other sales adjustments done in finance. Those are the functional areas. So per department, if you want to allocate those functional areas per department, we've got 3 departments. We've got sales and credit control. Credit control will be responsible for function 1, 2, 3, and 10, which means sales and credit control will be responsible for credit management, receiving of orders from customers, authorization of sales orders, and also processing and recording of returns and other sales adjustments. So if you go to a warehouse, for instance, they are responsible for functional area number 4, which is picking up of goods from warehouse, 5, which is dispatch and delivery of goods to customers, and 10, which is processing and recording of returns and other sales adjustment. Same with accounting or finance. They will be responsible for 6, 7, 8, and 9. We do the same thing. 6, invoicing. 7, recording of sales in the accounting records. 8 will be your receipt of cash from customers. 9 will be recording of receipts in the accounting records, and also responsible for functional area number 10, processing and recording of returns and other sales adjustments. So your sales return journal, your receipts journal, your cash receipts journal, your invoicing, and so on and so forth. It's actually the forte of the finance or accounting department. So you must understand what is happening in your receipts and your revenue and receipt cycle, because it makes sense if you're an auditor. How am I going to audit this function? Because you are looking at the risks that are actually peculiar to this functional and to this site. Right. 6.3.1 deals with accounting for revenue and receipts and receipt transaction. So this diagram actually depicts what activity is happening under accounting for revenue and receipt transaction. For instance, we're looking at an invoice. An invoice will go to sales journal to record sales, and sales journal then to your cash receipts journal. If it's cash receipts, like number 2, cash receipts, then it goes there. Then if there are some issues with the same invoice, issues pertaining to the returned goods, then we pass in a credit note. A credit note will be recorded under sales returns journal, and all these activities from sales, cash receipts, sales journal will affect your debtors ledger, which is a subsidiary ledger. So once you record it in your subsidiary ledger, you also push them to the general journal, your sales journal, your receipts, cash receipts journal, as well as your sales return journal to the general ledger. So now, because your general ledger is actually all-encompassing, everything, you have to deal with individual debtors under debtors journal. So you've got a list of debtors there, individual debtors, making up the sum that has been summarized into your general ledger as a debtors control account. You need to reconcile this to see if everything has been taken into cognizance. Your discount received, your discount allowed, your sales returns, your cash payments made by individual debtors. You reconcile if there are some reconciling items, meaning items that have not been taken into account in your general ledger, you actually reconcile those particular items. So on monthly basis, the general ledger and debtors ledger should be reconciled. From the general ledger, there comes a summary. A summary of a general ledger is called a trial balance. So a trial balance will actually form basis of the preparation of financial statements. So it the whole revenue and receipt transaction or cycle will actually end in financial statements. When it ends in financial statements, looking at your statement of profit or loss, you'll find that there's an assertion made by management with regards to revenue. They'll say revenue is an X amount. So what they are saying is that they've disclosed revenue properly, revenue is complete, revenue is accurate, and it's a valid revenue belonging to the company or to the entity. So those are the assertions. So the auditors will come and actually test if the assertions by management is actually true and get evidence to support whatever opinion they might actually come up with. And with regards to the receipts or with regards to the debtors and the receipts, they will actually do the same. So the bank account represents what management is saying is there. My bank account is complete, my bank account is actually accurate and it's valid. So, and I've got rights to that particular bank account. Auditors will have to come and actually test that those particular assertions by management. Same goes with accounts receivable or debtors. They will do the same under statement of financial position. Those assertions, obligations or rights. Rights is ours, valuation, debtors are evaluated properly, taking into cognizance your adjustment made for debtors that are impaired and debtors that have failed to pay, and which are called bad debts. Right. Any question? So far, no question. So let us move to 6.3.2, which is supporting documents, journals, and general ledger account. So the supporting documents that we might find in this particular cycle will be your credit application form. Credit application form is actually completed by a customer willing to apply for credit and who wants credit to be extended to them, and they should be credit worthy to get that. So once they do, they fill in that form, it's taken over for more assessment and due diligence. Master file amendment form, that happens in your computerized environment to say, okay, I'm adding a new data and I'm adding a new person who's able to buy or entity who's able to buy on credit. So customer order forms. So customers will send some emails, they will send in some forms and so on and so forth, but it will also prepare what we call internal sale orders, so that those sale orders are in a sequential form for control purposes. Also, a back order note. A back order note is a document that is completed when the stock is not available when the debtors, when the customers put their orders and back order, and they'll ask your guys from purchasing department to actually ensure that those goods are made available for the sake of a particular order. Then you do a back order and you get those goods because it's an emergency that they're supposed to be there. Then the other document that needs to be there, it's your picking up slip. Your picking up slip will be an authority for an entity to actually pick up goods for delivery to a particular a client who has made an order, and they need those documents, that form completed and signed. And from the dispatch, once they receive the pickup slip, they will actually complete what you call a delivery note. Once signed by the customer, it becomes an invoice is prepared. Okay, we continue with our documents. We've got your sales invoice. Sales invoice, it's actually well known. No need to explain it further. Suffice to say that it serves as a document to say you can start collecting. There is an obligation from the debtor or from the customer to pay a certain amount of money in exchange of the goods that were delivered to them. on credit. Or maybe it could be for cash as well. So it would be quick. You take your quotes and you take your invoice and you take our money as part of the receipt. Data statements on monthly basis. You need to prepare bank data statements, send them those statements to data so that they know how much they owe at all times. Then your customer receipts. Once the customers or debtors pay, they are issued with receipts. Remittance advice and proof of payment. So they will give us, debtors will give us proof of payment when they are using EFT. They will give us remittance advice if they are using checks, but checks are no longer used. So we require a POP or proof of payment from the bank to confirm that they actually paid their debts. Then we've got your mail register, which is actually an outdated supporting document since most of the stuff is done electronically. There are no longer shares that issue, checks that issue at present. Banks are not accepting any checks because payments will be made via mail, whether for cash or through post orders or through just cash. That particular activity was highly monitored. It also included, in some cases, security looking at how that particular function is being performed by people who are actually charged to do so. Your deposit slips, which has also been replaced by proof of payment. And proof of payments, because we no longer receive checks and deposit them and come up and end up having a deposit slip as proof of deposit being made. Then we have goods returned voucher that still exists. When you return goods, you enter them in a particular register and also issue what we call a credit note, and that serves as a goods received returned voucher, and then your credit notes. Okay, let's from the supporting documentation, let us look at what journals and ledgers are actually used in this particular cycle. We've got your sales or service journal. Sales or service journal is your sales journal, where whether sales are done on credit or are done on cash, they are actually registered there as a book of prime entry. When sales are returned, goods are returned because of issues. They don't satisfy particular client's quality control standards. They are defective, they are incomplete, and they don't meet the standard that is required of them. They're now returned, and when they are returned, they are passed through what we call sales return journal. Sales return journal is just adjusting your sales and also adjusting your data to recognize that the data has actually been allowed that particular amount or pertaining to those goods that were actually returned because of some other issues, either defective, quality issues, and whatever valid reason for the return. Then we've got your cash receipts journal, which is also known as cash book, where your cash receipts are actually entered into as part of books of prime entry. And you've got your general journal, where you deal with issues pertaining to your bad debts. Your bank account will also find itself there. Then we've got your debtors ledger, which is a subsidiary ledger dealing with debtors or dealing with accounts receivables. Then we've got your general journal, which is which represents control accounts pertaining to this particular cycle, pertaining to receipts and also pertaining to revenue. Right. So in a computerized environment, we find that there are databases for debtors master file, and there is a manner in which there are internal controls pertaining to how who is authorized to get into debtors master file. also price list master file and inventory master file in a computerized environment as part of the control. Then within the system, there are also reports and reconciliations that we need to look at. So in this particular cycle, we've got data's listing, which is a summary of all data's in a computerized system environment. And also, as part of the other report, we've got data's age analysis that pertains to both manual and computerized system. So data's age analysis is simply a matter of categorizing your data in terms of the days the creditors were extended and not paid by each category of data. Then you find that the data's age analysis is categorized as current, which is not bad, 30 days, no payment has been made, 60 days, 90 days, and above 120 days, and so on and so forth. So now, that particular report assess management to see how debtors are actually paying or not paying. So in case they are not paying, then they deal with the guys who are responsible for collection, and debtors should always be paying at least 60 days, 90 days, 120 days, and above 120 days outstanding is actually not desirable. Okay, the reconciliations that we'll get from this particular cycle will be all debtors reconciliation. We have alluded to debtors reconciliation to say you are actually reconciling your debtors control account with your subsidiary ledger called debtors ledger. So debtors ledger deals with individual debtors, and you compare with the amount, which is a summary of all debtors. That if there are some issues that need to be sorted out there are sorted, adjustments need to be made, they are made so that at all times your debtors ledger is always agreeing to your general ledger. And also with regards to bank reconciliation, it's actually an internal control system where you monitor your bank to see if all the transactions that have been recorded by the bank are actually authorized by the entity. You'll find that there will be some new debit orders that were incorporated illegally. When you do your reconciliation on a monthly basis, you pick up all those and report to the bank immediately. In this particular instance, I won't be talking about checks because we don't have checks anymore. Right. Questions so far? So there are no questions. So 6.3 depicts the flow of transaction in this particular cycle. So if you want, you can go to what page is this? It's page 196. So a flow of transaction pertaining to credit management. The flow of transactions pertaining to your receiving and authorizing orders from customers, picking up of goods from warehouse, and invoicing and recording of sales in the accounting records. Let's zoom in at credit management, for instance, so that we are able, when I'm not there, to be reading this and understanding this particular flow of transaction. This credit management function will be influenced to a greater extent by the customer who's applying for credit. So what you do is that you look at the credit limits of a new customer and determine or changes to the existing customer data's information are approved and increase in credit limits. Additions or changes are recorded, and additions or changes are reviewed and matched to the supporting documentation. So, right, when the credit limits are actually approved, then it should be supported by credit application form. And the credit application form should come from the customer, filed and captured, or the bookkeeper will capture that. So we also with credit limits, they are also recorded in your master file amendment form. And with regards to additions, you update your debtors ledger or master file in case of a computerized environment. So any additions, changes made in a computer environment, as it were, will go to a log of master file amendment printed. So each and every time you make changes in your master file, it's recorded, and you can print that as a log to say you have changed this. If the changes were authorized, when you review those logs, then the management will authorize to say yes, it was a legal transaction that took place in our computer. Right. So even if you go to the function where you are receiving and authorizing orders from customers, you do the same thing. So the customer order goods from the company, customer order is processed, and a back order note is issued if the items are out of stock, or internal sales order is issued so that we actually get them to invoice, and so on and so forth. So you can be able to read this and understand the flow of transactions, because just a diagram explaining the flow of transactions in each and every functionality. Your picking up of goods from the warehouse, your invoicing and reporting of sales in the accounting records, receipts of cash from customers, and recording of receipts in the accounting records. You can go through on your own. Then lastly, your processing and recording of returns and other sales. Right. That is your 6 diagrams that you will need to read through and understand as I've done your credit management one. Right, any questions so far with regards to that? Right, let us look at the risk pertaining to financial reporting. So in this cycle, we've got some inherent risk, particularly relating to the activities happening within the cycle. So the examples of fraudulent manipulation of accounts, balances, classes of transactions, events, or disclosures. If you look at revenue, there is a risk that we can record fictitious sales that are not in existence. So once you record that, our sales, our revenue will be overinflated, overstated, and once the revenue is overstated materially, it becomes an issue of modification of the report. Incorrect accounting period being made, that is dealing with issues pertaining to classification and cutoff. It's cutoff, in fact, not classification. Not recording all sales. So if you are not recording all sales for some reason, maybe you don't want to pay that, maybe you don't want to pay more tax, you just hold on to other sales, even if they pertain to a particular period, you don't disclose them up until the next period, so that you don't pay more tax or whatever. So that has a tendency of understating your revenue. Once revenue is substantially understated, it follows that the opinion, the auditor's opinion, will actually be modified. Also, there is a risk that you cannot recognize revenue in terms of the accounting standard, which is IFRS 15. So if you are not recording your revenue in accordance with the standards, it means you are not following the accounting standards or the accounting framework that you have actually alluded to, that you are following. So it follows that the modification of an opinion by the auditor is imperative in this particular case. So the standard that you need to follow here is IFRS 15. Right, let us look at 16.4.1, continuing, looking at the example of fraudulent manipulation concerning accounts receivable. So we find that there will be fictitious credit sales or fictitious debtors, and also understatement understated allowance for credit losses. So credit losses will be your adjustment for bad debts, as alluded to before. So if you understate those, then your financial statements will not be fairly presented. And also, fictitious credit sales will increase sales at the same time increasing debtors, thus causing both to be overinflated. So let us look at fraudulent activities pertaining to cash and cash equivalents. You've got your fictitious bank account balances, and you are not recording all your cash sales or receipts, as it were. So let's continue with financial reporting issues. We've got inappropriate revenue recognition. We've alluded to those. If you are not following the standard, which is IFRS 15, then you are not disclosing your revenue properly. You can either end up not fairly presenting your financial information in your financial statements. So specifically, when you do that, there are specific scams. The first one is called round trip billing, channel stuffing, and check kitting. So a round trip dealing is actually an artificial sales transaction, usually initiated between related parties, where one party sells goods or services to other, only to purchase it back from the other immediately or soon thereafter. So it's a fictitious sale, and it's done within an environment of related parties, and immediately after the year end, it's actually reversed because they wanted to achieve a particular end, which is manipulating financial statement. Channel stuffing. You force your customers to buy more than needed so that you achieve higher revenues. And at some point, they will have to return them. Check kitting. That is an abuse of time it takes for a check to clear at the bank. So hello? Can you hear me?
Yes, we can, sir.
But there is one person, I don't know, for some reason, I got muted. There is a question here. Okay, no, there's nothing, no question. So there is a risk because the receipts can also be in the form of cash. So there is a risk that there is a theft of cash. So the theft will be a physical theft of cash or funds from the bank by the employees' management of that part. Cash can also be kept at the entity or while in transit. So cash can also be fraudulently withdrawn from the bank account by electronic means. So those are the risks pertaining to holding cash. So there will be some specific risk of misappropriation of cash, which we'll deal with, just specific to cash. So here, these things leads to loss of the entity's assets. Right. There is something called lapping, which is a specific risk of misappropriation. So your cashier will dishonestly takes a check or cash receipts from self. Shortfall is in banking, but hidden in the accounting records. So it means you take the money, and when the other debtor pays, you just put in that money and balance it in that particular year. You always do that all the time up until you get caught. So you're always taking other debtors to cover up the monies that you have actually taken in the form of cash all the time. Then that is called lapping or rolling of cash. So you do this up until you are caught. or up until you are not at work. In fact, you catch people mostly when they are not at work, they are on leave, sick leave, and so on and so forth. Right. Let us look at dishonored checks. So this applies to check payments. So in the modern days, we're not using cash and checks anymore. So we're not going to dwell much on that. Then we've got the fictitious deposits. So you have electronic funds transfer and direct deposits only. You'll find people are depositing some money, pretending to have deposited some money. They give you a proof of payment that they've made an electronic transfers into your account, only to find that that was only fictitious and there is nothing in your bank account. So let us look how to actually deal with issues of being dishonest. Most of point of sale systems, they have what we call a barcode scanning just as a control. You've got your electronic cash register computer with POS software. You don't actually input the amount of goods. It's just you just scan the barcode, and the barcode will be connected to your price master file as well as price list and inventory master file. So that is used as a control to actually avoid the embezzlement or misappropriation of cash or assets within the computerized environment, barcoding. So in an electronic fund transfer system, you have your customers electronically transferring monies into the entities. Then they will send what we call a proof of payment to the entity after the EFT transaction has been made. So internet web sales is where a customer selects goods via internet on computer screen, pays via bank cards by furnishing card details on websites. Goods are dispatched to the customer by courier or postal services. There is a big organization doing that. It's called Amazon. They specialize in books, they specialize in music, and many other things. They are known for actually dealing with web-based sales and web-based sales. And also, there's a whole host of scams happening there in the internet-based sales environment. Right. Let's quickly look at the control objectives in the cycle. Just an overview. So the control objective has an aim of ensuring that transactions that are entered in the system are valid, accurate, and complete. Right? So there are some consequences which, when these control objectives are not met, we'll have misstatement of amounts in the financial statement, financial recording, that is, financial statements will be misstated or materially misstated if those three control objectives are not met. So if you want to meet those control objectives, then you've got to have internal control activities to ensure that those control environment pertaining to accounts receivables and revenue are actually met. So the control objectives in the cycle with regards to revenue, you are looking at validity, accuracy, and completeness of the cycle transaction. For sales, that is revenue, sales adjustments, and your receipts. Sales adjustment will include your sales return, includes the discounts that not discounts that you allow, your goods returned by customers, and also the receipts. So if you look at these transactions, you must ask yourself as to what are the consequences should the control the amount will be misstated, the cycle will be misstated, and the financial statements will be misstated, and the consequences is one of them, the financial, the audit opinion will be modified accordingly. So let us look at how the control objectives are achieved in the cycle. So you can only achieve the control objectives by implementing internal control activities to reduce the risk of the control objectives failing or not being achieved. This is done to ensure that sales transactions are valid, complete, and accurate. So valid means genuine customer signature on delivery note, authorized to sell only to pre-approved debtors, and also complete in the sense that delivery notes followed up for missing documents. All trace sales to sales journal to ensure were recorded, and accurate in the sense that checks are performed on the recorded amounts back to the delivery notes, quantities, and invoice price for the manual system to ensure that whatever has been sold has been recorded accurately and within the period in which they are relating to. So those are internal control activities within, whether they are manual or they are electronic, that are used to ensure that we achieve our control objectives. Control objectives being validity, completeness, and accuracy. Right? Any question pertaining to control objectives? So far, so good. There are no questions. So we have to look at the link between the control objectives in the cycle and management assertions. If you go to your book and look at the issues pertaining to the data of INCIMB piping, it's on page 210, you will see what we actually mean by linking them together. So they are applicable to transactions and events, revenue or revenue adjustments, and also on account balances, accounts receivable. So the control objectives, as alluded to, will be your validity, accuracy, and completeness that are peculiar to this cycle, your revenue and receipt cycle. So now management assertion, which needs to be supported, is that did the transaction occur? The cutoff of revenue was done properly. The cutoff meaning the revenue for a particular period has been recorded in that particular period. There is no overlapping of revenue recognition. So revenue recognition for a particular financial year is actually recorded within that financial year. For instance, if you've got a financial year starting on the 1st of March and ending on the 28th of February, all that revenue has been entered into, and we know the cutoff will be on the 28th or 29th of February. So anything outside of that will not form part of what needs to be recognized as a valid sales or revenue. Okay, with regards to accounts receivable, do they exist? Do we have data here, and we can actually go and visit them and ask for our money? They've got addresses and they are an entity, which means they've got their own personality, whether through legal means or it's just there are people who we can actually touch, or they are legal personas. Rights of accounts receivable. Do we really own those accounts receivable? Are the debtors in the accounts receivable our debtors? Then management has got to provide information to support those with regards to the control objectives relating to validity. With regards to accuracy, so we're looking at the prices, the amounts, the values are actually accurate, and the classification of revenue has been done properly, right? With regards to debtors, we're looking at valuation. Have we taken into cognizance those debtors that we are not sure whether they'll be paying or not? For prudence purposes, have we actually written off those debtors that we know they are not going to be paying anytime soon, and uncollectible, you write them off as bad debts. And allocation of accounts receivable, are they allocated there properly? So the management will show us, management will give us information pertaining to the assumption used to actually provide for doubtful debts or provide for impairment of debts, and so on and so forth. Then completeness within that particular period, looking at sales journals, all our delivery notes, all our invoices have been captured in a particular period. Everything has been captured. No sale has not been taken into cognizance. Management has to prove that to us as part of that assertion. Then completeness of accounts receivable as well. Our data is complete. Management needs to give us some information. This is what we have in terms of data. So those are the linkages between control objectives and management assertions, which needs to be supported by management. So let us look at the linkage applicable to transaction and events, that is receipts, transactions which make up the bank, the cash and bank account balances. So our control objectives in this cycle remain the same. Now we're dealing with bank. So management will support the occurrence and cut off. Very important. So our bank account includes up to the end of the financial year, this particular financial year. It doesn't overlap to other financial year. Yes, we've been using our bank account and these transactions actually occurred into our bank account. So they've got some proof for us or supporting documents to actually prove that for the sake of our control objectives. Accuracy and classifications. So management will actually ensure that our bank accounts are reconciled with your bank account is reconciled with your bank to ensure that there is an agreement or synergy between the two. Any issues that are not reconciled, which are reconciling items, are discussed with the bank and are adjusted for appropriately. And then lastly, everything that needs to be included in our bank account or cash is actually included there. That is completeness, and management should provide us with support. So we move to internal control activities happening within this particular cycle. So the control activities are actually those activities that ensure that the control objectives are not failing. So they are there to ensure that control objectives are not failing. So you have to have those particular activities. You've got to have as categories of those activities, you've got documentation and records, authorization and approval, you've got the segregation of duties, access controls, independent checks and reconciliations. That's what you actually have. We've spoken about reconciliation, independent checks. It's a matter of you ensuring that when you're making sales and you're transferring goods to the clients, make sure that before they go, the dispatch clerks has seen the goods, and the guys who are taking delivery guys, they will count the goods and say, okay, they are actually the number that has been and the quality that has been actually suggested by the dispatch, and then you can dispatch. Done by independent people. Reconciliation of allotted to access controls. You don't give access to everyone, you give access to people who are actually authorized to deal with stock. Segregation of duties, you segregate your initiation of transaction, authorization of transaction, recording of transaction, and custody of assets. So all incompatible tasks are actually needs to be segregated. And before transactions are recorded, they need to be authorized and approved. And the manner in which documents are kept and records are kept should be such that they are sequentially numbered and they are properly designed and they are placed under proper stationary controls, and they are used in conjunction with proper chart of accounts for transactions related to purchases and not to purchases, but to receipts and to revenue and payment cycle. So authorization or approval is customer is awarded the right to purchase on credit the entity, including the awarding of increase of the credit limits. Sales order is processed and a credit adjustment is made to customers' accounts, such as sales returns. So those are the controls pertaining to this particular cycle. Right. Then we look at internal control tables. Internal control tables, they display most common activities relating to internal controls for each activity. Then we also deal with the link between what should go wrong, which is your risk in the cycle, and the control objectives, and also the assertion and internal controls. So you will be looking at the internal control table soon. Then you've got your manual controls described in full, while the computerized controls are those in addition or alternate to the manual controls. Then we look at controls for manufacturing entities selling to customers on credit. Controls will vary for other types of entities, but control objectives remain the same in principle for all entities, whether they are manufacturing or non-manufacturing entities. Right. So let us look at one table, and I will expect you to be able to deal with the other table from 2 up to the last. So, like we did previously, we look at credit management, which is on page 215 in your prescribed book. So we also have control tables for receiving orders from customers, authorization of sales order, picking up, dispatch, invoicing, and so on and so forth. So let us try to look at one of them and see if you comprehend. If you comprehend, then we have to end there. Let me see if I've got. Let me stop sharing for a moment. Check if you cannot minimize. Okay. I need to look at this. And all right. I think I've got what I need. Now I need to share this with you. Okay, this is what I wanted to share with you now. And look at one control table and internal control table, and see if we do understand what is happening. Okay, let us quickly look at credit management. In credit management, we know that that's where we pass in on credit. Then we've got columns. Columns begin. We've got activity, and we've got the responsible party, documents, and records or master files. Then we've got our risk, and our risk comes in the form of a question: what could actually go wrong? And we've got your control objectives. The control objective could either be validity, accuracy, and completeness for this particular cycle. Then we've got your accounts or assertion affected, manual controls, and as it were, they said that the alternative controls are taken as computer control. Let us look at one. Allowance for credit losses and bank write-offs. Right. New clients wishes to order entities goods applied for credit. So who is responsible for that particular activity? It will be a credit controller, data capturer, capture clerk, or financial accountant or financial manager, depending on the entity and the quantum of the transaction. Right, documents that are needed will be your credit application form. We've alluded to that previously. Now they are summarizing the whole thing. So you've got to have your master amendment form, master file amendment form for debtors, but your log of master file amendments. Your log meaning that you've got your audit trail of what has been done, activities done on a master file. You've got your debtors ledger as part of your documentation of file. So debtors ledger, also referred to as debtors. Right? What could go wrong when the customer applies for credit? New customers who are not credit worthy, that is, cannot apply, who cannot pay their incurred debts in the future, are accepted and provided with credit. So when a client applies, then what could go wrong is that you can actually extend credit to a customer who is not credit worthy. And what is the control objective? New customers are credit worthy and would therefore be able to settle their debts, the debts they incur. So we are looking at control objective called validity. And now the assertion by management will be affected will be your accuracy, valuation, and allocation of trade debts. So what are they saying here is that, are we recording our data as accurate in terms of the amount that they've actually got credit for? Are we taking care of bad debts? Are we taking care of impairment of debts and provide as required? And are we allocating those to trade debtors accordingly? So those are the assertions that we are looking at: accuracy, valuation, and allocation of transaction. That is classification as well. So a manual control will be a customer completes a credit application form and submits trade references. Credit controller performs background check on customer trade references and confirms credit status with credit bureau. Right? So a credit controller sets a limit on the amount of debt a customer may incur and record it on the credit application form. Debtors ledger is reviewed by financial accountant or financial manager on regular basis for new debtors and agrees to application forms. So on the other side, which is alternate additional controls in a computerized environment, you'll be able to read those. They contain your ability to get into the data master file on the system, including the loading of new customers, removal of existing customers, and changing of credit limits is isolated to a specific individuals in the company, such as a data capturer, or the use of user profiles with a unique username and password. So you can read through all those. They are important, but now if you read them, you must know that we've done everything here. Now they are giving us this in the form of a matrix. You can get a question. In fact, you will get a question in your assessment dealing with the internal control tables. Able to identify the risk, able to actually put in necessary controls, also mention the assessments that are affected, control objectives, manual controls, or computer controls. So you might get a question on those. Then you move over to the next, which will be, this is still credit, look at receiving orders from customers and so on and so forth. Read those. In case you don't understand, you shout and we'll organized that you know what you're talking about. But I'm pretty sure that when you do your tutorials, attend your tutorials, then you'll be able to understand it. But read this, and in case you don't follow, have a consultation with me. I'll take you through this. Very important, but what is important is what we've done before we reach this. This is a summary of everything that we've actually done. If you read it, you'll see that it's a summary. Any question pertaining to debtors, not debtors, pertaining to revenue and receipt side? Okay, I take it there is no question. I would like to thank you, class, for attending this particular lecture. Time now is 3:47, and yeah, I think it's time to actually conclude the lecture. There are no questions, and it's one of the important lectures that we to offer in auditing. Understand this, because the next 3 lectures are dealing with the other cycles. Understand this first, because it's the core side. Thank you very much. Bye-bye.